Hi everyone, Kathleen Brooks here, Research Director at XTB London. We're now in December, which is Santa rally territory, and it's not disappointing. US stocks reached fresh record highs at the start of this week after a very strong November. There's no sign of demand for US equities slowing down as we move to the final weeks of this year. Positioning in the S&P 500 is completely one-sided at the moment, as investors are rushing to get exposure to the US index. There are also signs that the short positions are capitulating, which is helping to push the US blue chip index to higher highs. Of course, what goes up must come down, but for now, we think the stage is set for a broadening out of the US stock market rally beyond just tech. This week's payrolls report for the US is released on Friday. The market expects a reading of 218,000 for payrolls in November, which is much higher than the 12,000 for October. That number was an anomaly that was impacted by strikes and hurricanes in the American South. November's payrolls data is expected to show a return to normal levels for monthly payroll growth. It could also reinforce the idea that underlying momentum in the US economy remains strong. The path of US interest rates is also important for the stock market rally in the US. The Fed meet later this month, and there is now a 72% chance of a rate cut from the Fed. Fed member Christopher Waller said in a speech this week that he would be inclined to support a rate cut this month, and he also would support further rate cuts next year. Due to this, strong domestic growth in the US combined with a normalization of interest rates is a powerful driver for stock markets as we move towards 2025. The mid-cap Russell 2000 index has outperformed both the Nasdaq and the S&P 500, and we think that this can continue. Outside of the US, France is also in focus. The French government will face a no-confidence vote on Wednesday, and it may collapse. This comes after a clash between the Prime Minister and other political parties over the 2025 budget. French bond yields have been fairly stable during this budget fight. However, the spread between the French and German 10-year yield has widened to 2012 levels. The euro and the French stock market were also impacted by the negative sentiment towards France. However, French assets are in recovery mode as we move through this week. This is not because French sovereign risks have reduced, but instead because even if the government falls, the president can choose another technocratic government, and French parliamentary elections cannot take place until next summer. French sovereign risks have not disappeared, instead they've been pushed into the future. The day of reckoning for the size of France's budget deficit will come, but that day is not today. Overall, December market sentiment has started on a high. The oil price is also higher ahead of the OPEC Plus meeting this week. China is also reportedly mulling the prospect of more stimulus measures, which is also boosting the market mood. That's all for now. Thanks for joining.